Let's say you finally found the property. You and the seller agree on a price, you shake hands, you've got the money ready, you think you know what it costs. Well, you don't. At least, not yet. Because on top of the price you agreed on, there's a whole stack of taxes and fees that come with buying or selling property here in the Philippines. Sometimes people are surprised when the bill shows up and the numbers are bigger than expected. And I don't want you to be that guy. So in this video, I'm going to explain all of it, just exactly what you pay for and when to pay for it. If you're new here, I'm VJ and I am a real estate associate here in Baguio, and I help buyers and sellers navigate through the process of real estate. Before we talk about any tax, there's one question that decides everything. Is the property for personal use or is it part of a business? The answer changes which taxes you pay. If it's personal, your family home, or a lot you bought just to hold on to and sell later when it's worth more, the law calls it a capital asset. A capital asset just means property you're not running a business with. Most regular buyers and sellers are in this group. If it's part of a business, like a developer selling units in a subdivision, or a building someone actively runs a company out of, that's called an ordinary asset. Personal property is a capital asset. Business property is an ordinary asset. Same piece of land can be either one, and they're taxed in totally different ways. So let me walk you through both, starting with the one most of you will actually deal with. If you're selling a personal property, the seller pays something called capital gains tax, and it's 6%. You'd think 6% means 6% of your profit, right? Well, it doesn't. It's 6% of the property price, whether you made money or not. And it gets more specific. The government doesn't just use the price you sold at. They look at three numbers and tax the highest one. One, the price you actually sold it for. Two, the fair market value, which is basically the property's general market worth. Three, the zonal value, and that's just the official price tag BIR assigns to every area, and every location has one. Whichever of those three is biggest, that's the number they charge 6% on. So imagine you bought a lot for 2 million, the market dropped and you sell it for less than you paid. So you lost money, but you still pay the 6% because it's based on the price, not your profit. One good thing though, this 6% is what's called a final tax. It means once you pay it, you're completely done. You don't owe anything else on that sale, no more forms, no adding it to your income. And there's a legal way to skip 6% entirely. If the home you're selling is your main home, the one you actually live in, you can be exempt from the tax, but only once every 10 years. And only if you follow three rules exactly. One is you take all the money from the sale and you use it to buy or build your next main home. Second is you do that within 18 months of selling. And lastly, you have to tell BIR you're planning to use this exemption within 30 days of the sale. If you miss that 30-day notice, then you lose the exemption completely, even if you did everything else right. So if you're selling your home to move into a new one, this can save you the entire 6% if you just file the notice on time. Now let's move on to the other side, property that's part of a business. This one's heavier and three things come into play. First is a 12% tax called VAT, or value added tax. You've seen this VAT all over the place in your grocery receipts. It's the same idea, just applied to the property's price. There are some exceptions, like low-cost socialized housing, and homes sold under a certain price set by the BAR, which is 3.6 million. Outside those exceptions, the 12% VAT applies. Now, second, instead of VAT 6% capital gains tax, the buyer holds back a portion of the payment and sends it straight to the BIR. It's called a creditable withholding tax, and it ranges from 1.5% up to 6%. Third, the seller also pays regular income tax on their actual profit. Same income tax a business pays on any earnings. It does sound rough, but there's one real upside here. Because business property is taxed on your actual profit, you're allowed to subtract your costs and expenses first. So you're taxed on real earnings, not just the sticker price. And that's actually fairer in a lot of cases. Say you have a property that hasn't been used for business. Now, if a business owns a property but stops using it completely and it sits totally unused for more than 2 years, it automatically switches back to being treated as a personal property. When you sell that property after that 2 years, then you skip the heavy 12% VAT and fall back to the simpler 6%, which is a capital gains tax. No matter which type of property it is, there are a few fees that show up in every single deal. And this almost always land on the buyers. So if you're buying, set aside money for this on top of the price. One is documentary stamp tax, which is 1.5%. This is basically the government's fee to make the sale official on paper. Then you have a local transfer tax paid to your city or province for transferring the property to your name. It's up to 0.50% in the provinces and up to 0.75% in Metro Manila. You also have a registration fee, about 0.25%. This goes to the Registry of Deeds, the office that officially records you as a new owner. Each one looks small, but add them all together with the main tax and it's real money. This is exactly why I tell every client, the price on the listing is not yet the final price you pay. So always budget for the extras. So how does a deal go from we agreed to the property is legally mine? There are actually 6 steps. And you have to pay attention to the deadlines because that's where people get hit with really painful penalties. So step 1 is to sign the deed. Both sides, the buyer and the seller, sign an official document called the Deed of Absolute Sale and have it notarized. That's the legal proof that the sale happened. Now step 2, you have to pay the national taxes to the BIR. Here's where the clock starts. The 6% capital gains tax or the withholding tax for business property is due within 30 days of signing. The documentary stamp tax is due by the 5th day of the following month. If you pay that late, you get the penalties. Now step 3. Get the e-car. The e-car is basically the BAR's official permission slip that says all your taxes are paid and the property is cleared to transfer. You hand in the deed, the tax documents, your IDs, and your receipts. The BIR checks everything, and they give you the e-car. Without it, you literally cannot transfer the property. Now, step number 4. Pay your local taxes. The buyer pays the local transfer tax at the city or town treasurer's office and gets a clearance proving the property's taxes are all paid up. And then you move on to step 5, which is to register the title. You bring the e-car, your clearances, and the deed to the Registry of Deeds. Now, the title officially becomes yours. And for the final step, you have to update the records. You bring your new title to the local assessor's office so all future property taxes get billed to you and not to the person you bought the property from. Now, that's the full journey. It's a lot of steps, but each one has a purpose, and a good agent walks you through every single one. So that's the tax side of buying or selling property. I know it's not the fun part, but the people who understand this before they buy or sell are the ones who never get surprised. So they budget for the extra costs, they hit their deadlines, and the whole thing goes smoothly. The ones who skip it find out the hard way at the very end. If any of this feels confusing or you've got your own situation you want to talk through, just reach out to me, and that's what I'm here for. That's it for this one. If it helped, don't forget to subscribe to the YouTube channel, and I'll see you on the next one.